Hello everyone, welcome to my channel. I'm very excited about today's episode. If you plan to buy in 2026, but you don't know where to start, or you have been doing everything right, but just feel very much stuck, this video is for you. I want to educate, inform, and make the home buying process as easy as possible. Let's get started. You know why I create this roadmap? 76% of buyers say they actually learning the rules after they have found a house or while they're house hunting. I feel like that is a bit too late. Also, when you talk to the realtor who do not know your financial picture, who do not know your budget, they tend to oversell your house that you don't really need. And when you start late, when you understand on the job, stress inevitably happens and you make wrong decisions. That's why I create this roadmap. It's a 7-step series, okay? The first one, you have to understand the rules, understand how the lenders see you as a borrower, how they manage the risks. Then you can prepare the numbers based on those rules so you can focus truly on what matters and save your time and energy on things that don't really matter. Okay. Then we can secure a smart pre-approval based on the budget that we all agree on. Then, until then, you can work with the realtor. You can go house hunting. You can figure out how to make an awesome offer. Then we're going to talk about navigate the escrow process. And lastly, minimize any last minute changes so that you can close smoothly. So that's my 7-step roadmap. And today we're going to zoom in to step number 1, understand the rules. But before I jump into that, I want to debunk some of the most popular myths about homeownership. Myth number 1, this is a big one. You need 20% down. Most people still think that way. That's why they try very hard to save. The reality is there are plenty of programs out there that do not require any down. There's also state level down payment assistance programs that are deferred, so you don't pay them back until you sell that property or you refinance the loan. The conventional loans for first-time buyers is usually 3%, FHA 3.5%. So to think you need 20%, in most cases, will stop people from moving forward because it's a huge task. What if I told you if you saved the extra $30,000, you're only going to save $200 a month? That might change your perspective, would it? Myth number 2, you need perfect credit. 2025, Fannie Mae has done a big surprise thing. They have removed the minimum credit score requirement. So nowadays, lenders focus on not your whatever happened in the past, more like what did you do in the last 12 months? Have you had timely payments on your open auto loans, car loan, student loans, personal loans? They also don't just they also do not just approve you based on one score. They will look at your income, your employment, and reserves. So it's like overall picture. So credit repair is not the most important thing, but you do want to know is, okay, what is the easiest strategies I can use to raise the score that can help me with my rate? But that is not the most important thing. And there are plenty opportunities that you can get a loan approved without a perfect score. And in the lending business, perfect is 740 and above. If you get 740, you're going to have the best rate. Myth number 3, wait until everything's perfect. I got to have all the down payment. I got to have my perfect score. And then I'm going to wait until timing is just everything just works out. In the world of homeownership, perfection does not exist. It's a fantasy. Readiness does not mean perfection. You want to understand how do you want to plan right in the right order. That truly matters, not perfect timing. Myth number 4, this is a good one. Renting is cheaper. I can't argue if you just want to rent, right? Even though I do believe renting is a short-term strategy. In some cases, it works. But homeownership builds long-term leverage. Rent is 100% interest. you are paying landlord's mortgage, right? One way or the other, you're paying mortgage, whether it's landlord's or to yours, and rent can increase. It's not like the landlord does not pass on any expenses. If mortgage is fixed, the payment stays the same. Now that we have busted the myth, let's talk about how the lender evaluate the risk. I put them into 4 categories. Pillar number 1, income, credit, debt-to-income ratio, and savings. I put savings last for a reason, and I'm explain it to you. First, let's talk about income. It's the 2-year rule, okay? Same line of business and same employment for 2 years. Schooling counts too, whether it's trade school or nursing school, that count as employment. Stability is important. If you have declining income or employment gap, you have to explain it. So you have to prove it too. Two pay stub that will cover 30 days. My birthday coming soon. That's funny. Or if you need 2 years tax returns, if you're self-employed, take out all the expenses, you average out the net. Now, what if you write off a lot of expenses? What do? It's okay. We're going to cover in a separate video to talk about bank statement loans that's specifically for self-employed people who write off a lot of expenses. So if you understand the income, what they're looking at, what you want to avoid is hopping different jobs all the time, unless it's a huge salary increase, or switch from a W-2 to 1099. That's a no-no. Pillar number 2, credit. You know, Fannie Mae removed the 620 minimum FICO score in 2025. So they don't want you to think about all the collections, the charge-offs that happened in the past. Focus on on-time payments going forward. That's 1. And number 2, credit utilization. That is really the key. The 10 and the 30 rule. 10 rule is 10% for each individual credit line, not to exceed 10%. 30 is the aggregate, not to exceed 30%. And that's the reason why I put savings last, because I want you to focus not maxing out your credit card, but pay that down as fast as you can to under the 1030, right? Then you can start savings. Because a lot of people have maxed out credit cards at the same time they're doing savings. That's not a good strategy at all. It still does not help your score in any way.